Welcome to RobTech 2045. Today, we're uncovering how Oracle went from an all-time stock market high to a massive debt-fueled AI gamble, and why its future may depend on whether this extraordinary bet pays off. In September 2025, Oracle Corporation was on top of the world. After nearly 5 decades of transitioning from a database pioneer to an enterprise software giant, its stock hit an all-time high of $345.72. Co-founder Larry Ellison's net worth peaked at a staggering $393 billion, briefly making him the wealthiest person on the planet. But beneath this glittering peak, a tectonic shift was occurring. Longtime CEO Safra Catz, the architect of Oracle's famed Wall Street financial discipline and cautious transition to the cloud, stepped down. In her place stood 2 newly appointed co-CEOs, Clay McGuirk and Mike Cecilia. This leadership transition marked a definitive end to financial caution. The engineering-driven co-CEOs were ready to execute a high-stakes, hyper-aggressive pivot into artificial intelligence infrastructure. They were ready to bet the company's balance sheet on becoming the ultimate physical landlord of the AI revolution. To understand how Oracle ended up in its cash-strapped position, we have to look back to January 2025. At the White House, Oracle joined OpenAI, SoftBank, and MGX to announce the Stargate project, a massive $500 billion joint venture to build 10 gigawatts of AI compute capacity in the United States. But Oracle didn't just participate, they went all in. To financial analysts, this was a staggering level of customer concentration risk. Oracle had essentially tied its corporate destiny directly to ChatGPT. Oracle signed a monumental compute deal with OpenAI worth over $300 billion over 5 years. This single transaction was so massive that OpenAI accounted for 58% of Oracle's entire contracted backlog. To fulfill this demand, Oracle had to build massive, liquid-cooled, GPU-filled data centers, and building them required cash Oracle simply did not have. On December 10, 2025, Oracle released its fiscal second quarter earnings report. The numbers inside sent an immediate shockwave through Wall Street. Capital expenditures had surged to $12 billion for the single quarter, way up from $8.5 billion in the previous period and far exceeding Wall Street's expectations. Worse, Oracle's massive spending had pushed its free cash flow into a negative $10 billion abyss. During the post-earnings call, executives shocked investors by revealing that capital expenditures for the fiscal year would hit $50 billion, a massive $15 billion spike from their September guidance. Wall Street's reaction was brutal and instantaneous. On December 11, 2025, Oracle shares suffered a devastating 16% intraday plunge, the company's largest single-day decline since the dot-com crash of March 2001. In just a few hours of trading, over $100 billion of market value was wiped out. At the same time, the cost of protecting Oracle's massive debt against default rose to its highest level since the 2009 financial crisis. Oracle's credit derivatives were suddenly transformed into a market barometer for AI-related financial risk. By January 2026, Oracle was caught in a brutal squeeze play. Frustrated bondholders filed a class action lawsuit in a Manhattan court, claiming Oracle had failed to disclose the massive debt it knew it would need to raise to build its AI data centers when it sold them $18 billion of bonds in September 2025. But Oracle had no choice but to keep borrowing. In January and February of 2026, Oracle embarked on a historic borrowing binge, raising $58 billion in new debt in just 60 days. This pushed the company's total debt position past the $100 billion mark. Meanwhile, its trailing 12-month free cash flow deteriorated to a deeply negative $24.7 billion. Credit default swap spreads tripled, and ratings agencies S&P and Moody's placed Oracle just 1 and 2 notches above junk status, respectively. To fund its massive GPU clusters, Oracle was burning cash, taking on billions of dollars in long-term liabilities, and even resorting to demanding 40% upfront deposits from new customers to build out their data centers. Something had to give. On the morning of March 31st, 2026, tens of thousands of Oracle workers across the globe woke up to a brutal reality. Sent at approximately 6 a.m., a formulaic email from Oracle leadership informed 30,000 employees, roughly 18% of Oracle's global workforce, that their roles had been eliminated immediately. No direct meetings with managers, no warnings from HR, and immediate system lockouts. The cuts were massive and sweeping. The Revenue and Health Sciences Division, which housed Oracle's $28.3 billion Cerner acquisition, was gutted by 30%. SaaS and virtual operations took a similar 30% hit. In Kansas City alone, over 500 Cerner legacy workers were laid off. Key executives sent in to fix the Cerner acquisition departed, leaving a massive leadership vacuum. To fund physical buildings and chip leases, Oracle chose to sacrifice human capital. The company paid a massive $1.84 billion in severance and retirement expenses to free up an estimated $8 to $10 billion in annual cash flow. By the time the dust settled, Oracle's stock had plummeted over 55% from its September peak, trading at roughly $152 by March 2026. Oracle's stock collapse was not caused by a failure of demand. In fact, Oracle's quarterly revenues were up 22%. Instead, it was the financial paradox of the generative AI era. A company forced to starve its core software products and gut its workforce just to feed the colossal, insatiable capital requirements of physical AI infrastructure. Oracle placed a high-stakes, multi-billion-dollar bet on OpenAI and Stargate. But in doing so, they left themselves with a heavily leveraged balance sheet, negative cash flows, and a gutted workforce. Whether Oracle emerges as the premier landlord of the AI age or the ultimate fallen angel of a debt-fueled tech bubble remains the single most important question on Wall Street.